Joining me now, we've got Sandra Cho, who is the Pointwealth Capital Management CEO and founder. You say the worst thing that investors can do right now is panic sell. Break that down for us.
Hi, this is Sandra. Nice to have you. Nice to see you again, Brad. So yeah, I mean, the worst thing you could possibly do would be to, sell during this panic time. You really want to see this as an opportunity, especially for long-term investors. So if you're in for the long term, dollar cost average into the market, buy the dips. And typically for long-term investors, it's a good entry point when the VIX is at 30 or above. The next 3, 6, 9, 12 months actually outperforms historically.
And so with all of that considered, where are the areas of the market and what is kind of like the decision tree that you're recommending people work through in order to best qualify what's a trade that they should be buying on the dip versus one that's down for very good reason that they should probably be staying away from until there's a little bit more clarity?
Sure. I mean, you want to stay with the common stocks that tend to outperform, or the common sectors that tend to outperform during downturns. Stocks like, consumer staples, utilities, healthcare. We're looking at Costco, Walmart, Next Era Energy, Duke Energy. In the healthcare area, we're looking at Johnson and Johnson and United Health. And then, something that's kind of just a globally diversified bellwether is, ETFs such as DIV. So these are high dividend paying, globally diversified stock ETFs where, you can dollar cost average in and you're getting paid to wait, right? You are getting paid 6.61% in DIV. And you could just, continue, wait. We've never been through a downturn that we haven't recovered from.
And so as you're thinking about some of those sectors and stock picks where you're identifying opportunity, what should people, especially in assessing what the fear gauge index, the VIX, can tell them about how much more volatility could be yet to come? How should they be assessing their portfolio up against that volatility amid some of the turmoil that's played out?
I mean, I would moderate expectations, our own expectations of, that this is going to be short term, right? I really, our base case is that on the front end, a lot of countries are talking about retaliatory tariffs, but on the back end, they're likely having discussions and there are likely going to be some concessions. And then, after that, there might be some kind of relief rally. But understand that these tariffs, are going to remain at elevated levels. So you really do want to expect that the volatility is going to continue, for the next, few weeks or months. Not all tariffs even have been announced, right? So there's potentially more tariffs to come. But that said, you really want to look at this as an opportunity because our investments are, long term. You don't want to be just in the market, which is known to be volatile anyway, over the short term, over just a few months.
And so just lastly, while we have you here, as we're thinking about the checklist of what to do if one of your investments is very clearly embroiled and caught up within some of the tariff talks, how do you work through that checklist and then aptly make decisions?
Sure. So, now is a good time to tax loss harvest. So if you've got gains, if you've got a position that, has still substantial gains in it, now's a time to maybe look at, selling some of that or even all of that and maybe buying something comparable so you don't have, you're not out of the market, right? And then that way you're able to, capture those gains, but, not have such a huge tax liability and still be in the market. Now, if it's lower, than where you bought it, maybe you even buy more of that sector so that you're not overly concentrated in that one particular stock.
Sandra, thanks so much for taking the time here with us. Good to see you.
Thank you.